Hello everyone. Welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. Before we begin, let me ask you something simple. Have you ever planned or how much money you will need to run a shop, buy a new stock, or repay a loan and wondered, will I have enough profit after all this? So if your answer is yes, then guess what? You have already used the basic idea of financial modeling, even if you don't know the name of it. So financial modeling isn't some big English concept. It's just a smart way to look at your income, expenses, profits, and future planning in numbers. So today's webinar is all about learning how to use numbers not just to record the past but to predict the future also, taking better decisions and grow confidently. So let's start the journey where we have turned number into a clear history of our business. So in our previous session we have covered multiple topics like WACC, importance of WACC, formula of WACC, and risk averse investor, marginal return, beta regression approach, bottoms up beta, mean reversion, and beta drifting. We have covered them in our previous session. So in today's webinar, what we will be doing, we will be starting with our return on market, which means return on market means how much return the overall market like Nifty Sensex gives us on average to us, right? So it tells us how much profit investors made by simply investing in the overall market. So for the same, the formula will be return on market is equals to ending market index minus starting market index plus dividends divided by starting market index into 100. These formulas are being taught so that we can apply it when we are doing our financial modeling from scratch, right? For the companies we have taken. Next is our example. So for example, my return on market where my Nifty had started at 16,000 and ended at 18,000, and my dividends received during the year was 200 rupees. So 200 points, sorry, just to mention it, right? So I have received 200 points. So my return will be 2200. How it has been calculated? It is calculated as 18,000 minus 16,000 plus 200 points. So it will be giving us 2200, right? So after that, when we want return on market, so what we have to do, we have to divide it by Nifty started amount into 100%. Then it will be giving us 13.75% return on market, right? Then comes our why it matters. So it acts as a benchmark. So if I invest in my own business or a stock, am I earning more than the market gives? So if not, I might as well invest in index funds or FDs, right? Then comes our average return. Average return, it means the average of returns you earn over a few years or month, right? So for the same, formula will be average return is equals to sum of returns over the years divided by number of years. So if we take our example for the same, so I have year 1 data as 10%, year 2 as 15%, and year 3 as 5%. My average return I have to calculate. So my first year market return is 10%, my second year market return is 15%, and my third year market return is 5%. So if I want to calculate, I will be calculating it by the formula average also, which is inbuilt in Excel sheet, or I can do the calculation by adding these three and dividing it by 3. So I will be getting 10%, and you all can use both the formulas or one function also for calculating average returns, right? Then comes our why it matters. So it tells us how much well our investment is doing over the time, not just in one good or bad year, right? So Next comes our dividend yield. So it is the cash return, which is dividend you get from owning a share, like interest from FD. So for the same formula is dividend yield is equals to annual dividend per share divided by market price of share into 100. So for that particular dividend yield, we will be taking an example where we are buying a share of 200 rupees and company gives us 10 rupees dividend per share. So if I want to calculate my dividend yield, so how to calculate that? I will be calculating it by dividing my company which is giving me 10 rupees dividend per share, which will be divided by my buying share price into 100. So after that we will be getting 5% dividend yield, right? So why it matters? So it tells us how much income we are getting from holding the stock, and very useful for retirees or long-term investors who want regular income. So there it is necessary for investment, right? Then comes our intrinsic growth rate, where this is the natural rate at which a company can grow using its own earnings without taking extra loans or equity. Sorry. Then comes formula, where intrinsic growth rate is equals to return on equity into retention ratio. So retention, with the name retention, you might be getting the point which we have covered in our previous session, which is our retention rate, which is the customers who are coming after everything, or we are retaining them by giving them services, good services, and providing them discount. They will be giving us business, so that those consumers are our retained customers, right? That only means retention. Retention is stopping or giving some good services and also providing them good customer support. That's what a retention ratio will be, in other words, right? It is a simple meaning which I am telling you. And also retention ratio is equals to 1 minus dividend payout ratio. It is also the formula for retention ratio. Then comes our example, where our intrinsic growth rate is ROE. ROE is our return on equity, which is 15%, and company pays 40% profit and they retain 60%. So what will be the intrinsic growth? So we have to multiply our return on equity by our retaining. So we will be getting 9% of intrinsic growth of our business. So why it matters? It tells you if the company can grow on its own, or does it always need loans and funding. So a company with a good intrinsic growth rate is financially healthy and self-sufficient. Then comes our common size statement, where this is a type of financial statements like income statement or balance sheet, where every item is shown as a percentage. In income statement, everything shown as percentage of sales. In balance sheet, everything shown as percentage of total assets. So there are two types of common size statement. One is our income statement and another one is our balance sheet. So for example, let's take item where sales amount is 10 lakh. So how much percentage of sale it is? It is 100 percentage, right? Cost of goods sold is 6 lakh. So it is 60% of our sales. Gross profit is our 4 lakh. So it is 40% of sales. Operating expenses is 1,50,000, so it is 15% of sale. And net profit is 2,50,000, so it will be my 25% of sales amount, right? So why it matters? It helps comparing companies of different sizes, shows where the money is going, and makes it easy to spot inefficiencies also. So for example, in the same common size statement, if my net profit is only 10% and my competitors is 25%, so we know something is wrong with us, right? Then comes our case study of Ramesh Supermart, where we will be discussing about the same return on capital and all. So return on market, where Nifty went from 17,000 to 19,000 and dividend received is 300 points. So here we have calculated our 13.75%. How? The same way we will be calculating over here, like 19,000 is subtracted from 17,000 plus our 300 points, then it is divided by 17,000 into 100, so it will be giving us 13.53%. This is our return on market, right? Then comes our average return. So Ramesh checks his profit percentage over the past 3 years. So year 1 he is getting 15% profit percentage, year 2 he is getting 8%, and year 3 he is getting 12%. So average return to calculate is, I already told you all that we can calculate it by adding all the 3 and dividing it by 3, or we can use the function of Excel as average and we will be selecting the array. So it is giving us average return of 11.67%, right? Then what return on market is 13.53% means, like Ramesh has to earn this much percentage or above than that, otherwise he will be a recurring loss, right? So if we calculate our average return, so it is normal but can be increased to 13.53%, otherwise he will incur loss. Like, then dividend yield, where each share is worth of 200 rupees and company is giving dividend as 10% per dividend, so dividend yield will be 5%. How to calculate that I have already mentioned in my above examples, that we will be dividing our 10 with our 200 and will be multiplying 100, so we will be getting 5% of dividend yield. Then comes our intrinsic growth rate, where Ramesh keeps profit 60% and also withdraws 40% for home needs. So his return on equity will be 20%. So if I want to calculate my intrinsic growth, so I will be calculating it by 20% into my Ramesh keeps keeping profit, which is 60%. So intrinsic growth will be 12%. So if I calculate my common size statement, so my sales is 10 lakh, so it is 100% of sales. Purchase cost, if I want to calculate, it is like 6,50,000, which is 65% of sales. Then I will be calculating my rent plus salary, which is 1 lakh, so it is 10% of sales, and utilities are 50,000, so it is 5% of sales, and net profit is 2 lakh, so it is 20% of the total sales, right? So now we will be doing some practice in Excel. So for the same thing, let's go to our so in our previous session we have calculated our average cost of capital, weighted average cost of capital, where we have understood the peer comps, where we have taken 6 companies, FMCG companies only, and we have calculated cost of debt, equity, capital structure, levered beta, and weighted average cost of capital. Now what I have done, I have taken data of the same companies but in different manner. So what I have done, let me show you all. So I have done a small change. I have taken Hindustan Unilever Limited from Srina.in and I gone down, and over here I am able to see the peer comparison. So I want to do edit columns. It is already having debt to equity, market capitalization, and once I save then this particular Hindustan Unilever, ITC, and Hindustan Food and Godavari bioreference, it will be copied same and it will be pasted over here, right? So I have done total data pasted over here, and total equity will be pasted here, right? And tax rate will be common as 30%, and all the same thing will be applied in this full chart, right? Only one thing you have to do, like if I want to calculate my beta, so in my previous this file I have taken levered beta as one commonly, but for my different companies I will be going to my Google and will be searching for my beta of Hindustan Unilever, and will be taking beta from there only, and then I will be calculating my unlevered beta. So like that only there's a change, otherwise every single thing will be same as we have done in our WACC of companies, 6 companies, right? Here we have calculated total equity and total debt. Here we have taken on paper data. We don't have to calculate or add those two heads. We just have to take data and copy paste it over here, right? Now coming to our beta regression. So we have discussed about beta in our previous sessions also. So for calculating a regression beta, for I will be taking my HUL, which is Hindustan Unilever Limited. So I will be taking HUL weekly returns where I want 2 years weekly data. So what I will be doing, I will be going to my Hindustan Unilever, where I will be going to my Yahoo Finance, and I will be selecting from there Hindustan Unilever Limited, and I will be going to my historical data, and I will be giving them the price, historical prices weekly, and I will be mentioning the dates from June 16 2023 to June 16 2025, and then I will be copy pasting this data. Only I need adjusted closing data. So what I have done over here, I have taken my data over here so that I can just copy paste from here. So my Hindustan Unilever's data is this. So what I will be doing, I will be copying this data and pasting it in adjustment closing. So this is calculated. Right now I want to calculate my returns. So what I will be doing, my 2022 data is not there, so I will not take that data also. So what I will be doing, I will be taking my May 1 2023 data from here, and I will be dividing it by May 8 2023 minus 1. The same formula we have been using from our previous sessions, and it will be calculating our returns for HUL weekly returns, right? The same will be done for our Nifty data, where we will be taking Nifty's data from the same side, Yahoo Finance, and we will be taking from 2023 to 2025, June 2023 to 25, and we'll be taking the Nifty 50's data and copy pasting only the adjusted closing amount, and from here we will be taking it to our beta regression. Same thing will be applied, and the same formula will be copy pasted over here and will be copied, right? So it is giving us value. So what happens sometimes that the matter or the digits or the numbers are not in a good form. That's why it gives us value thing. So what we have to do, we will be going to our number, and again we will be moving forward. Here we will be taking this. Here there is gap, so what we will be doing, 24,751. There is a gap, 24,853. Everything was right, only the matter is we are copy pasting it, so the formatting is sometimes not good. That's why it shows us error. We just have to do right. Again, for the same, what I will be doing, just a small correction we need to do in our sheet so that we can get our work done on smooth basis. So my whole data is right. So here also there's a gap, that's why it is calculating value right. Then here also it is the same, so what to do in that, right, there's a space in between decimal and the number, so it is right. So our value 1 is completed. Returns can be negative. Okay, try to understand when there is a company and it is listed in stock market and it can incur returns in negative also. So don't worry about it why it is giving negative returns. Market is very volatile and it can gives us negative returns, right? So for calculating beta, what we will be doing, we have three options to do that. First time we have to calculate our beta, so we will be taking slope, and then we will be taking our HUL's data, which is returns, comma, and returns of our Nifty, and bracket closed and done. So our beta is 0.5984. So if we remove, so our beta is 1, right? Now if I want to calculate my covariance, I will be taking covariance as sample over here. So again my array 1 will be returns from this part of HUL to my Nifty 50s data set and paste it. Okay, and also one thing we have missed out, we will be dividing it by variance, which is also a sample tab, and then we will be calculating with our returns of Nifty 50. We will be dividing it by this and done. So it will be showing us beta 1, right? Now if I want to calculate my beta in third format, so if you all remember, I have given my one editing of Excel where we have to enable our analysis tool pack. So for why that tool pack was enabled, so that we can get a data analysis from our Excel sheet. So once we click over here, it will be asking us what do you want. We want regressions. Okay, then it is asking us, one second, okay, just a second, okay. So over here we have taken y as our HUL, so we will be taking regression. Okay, it is asking us input y range, so we want this range. And now x range, it is Nifty 50s data, and it is asking us output range. We want output over here, and okay, now we will be getting summary output of the same data which we have put in that place. So it is also giving us x variable 1 as beta 1, so we will be linking it with this place, right? Again, what we will be doing, we will be removing decimal and it is coming 1. So we can think about investing in this market, right? Now we have to calculate our levered raw beta, where we will be taking our beta as this, and raw beta weight we are taking as 0.75, or we can take as 0.75 or 75 percentage, sorry, 75 percentage, right? And market beta, let's take 1 over here, and mean market beta will be 25 percentage. So now if I want to calculate my adjusted beta, so for that we will be calculating it through our levered raw beta into our raw beta weight plus market beta, again brackets open, into market beta weight, and done. So I will be getting my adjusted beta as 0.69 so it will be coming at 1. So this is what our beta regression means, right? And also we can calculate our beta in these 3 forms with different formulas and functions also we can calculate. Now coming to our RM, which is already calculated. So what I have done over here, I have taken RM, which is return on market, which we have discussed in today's webinar. So what I have done, I have taken my data from my primeinvestors.in site. So it is giving me this particular site. Now what I have to do, I will be going to my more section, and under more section I will be going to my tools, where I will be getting Nifty 50 return chart. So there I will be getting my Nifty 50 returns last 20 years data. So what I will be doing, I will be here, it is the small font, it is giving us get the data. Once we have clicked on this, it will be giving us whole 20 years sheet. So what I will be doing, I will be taking this year, and also I will be taking this annual data and copy pasting it over here, right? My whole data is there. As I am taking annual, that's why I haven't taken today's or this year's data. Now if I want to calculate my average return, so I will be doing average return as averaging out my annual data. It will be coming as 15.33 percentage. Then if I want to calculate my dividend yield, so dividend yield will be stated over here as 1.29. So I will be giving a superscript over here as 1. Now I have to calculate my total market return. So what I will be doing, I will be doing sum of these two. Then I will be getting 15.33 percentage of total market return. So this is how we calculate our beta regression and return on market. So what we have learned today is that numbers don't lie, they guide us, right? Financial modeling help us answer everyday questions like, will this idea be profitable? Can I afford a loan? How long before I break even? What's the real return I am getting? So whether it's return on market, average return, dividend yield, or even intrinsic growth, each of these tells a part of the story. And when you bring them together, you don't just run your business, you lead it with clarity and confidence. You don't need to be a finance expert or speak perfect English to build wealth. You just need to understand what your numbers are saying. Start small, check your income and expenses, see what's giving you more returns. Even simple actions like tracking profit percentage, knowing your loan cost, or comparing with market returns can make a huge difference. So, thank you for joining today's session. I hope this gave you clarity and confidence to use financial modeling in your own life. Stay curious, stay aware, because your future is built one smart decision at a time. So, see you next time, and until then, let your numbers guide your growth.